Hello, I'm Iman Bacodari,
And I'm Gabrielle Correo.
and we're the Bacodari Team coming to you from Douglas Elliman headquarters in Midtown Manhattan. Very excited to talk to you about the June 2025 state of the real estate market. So let's get into it. So, Gabrielle, how do you find the market these days?
The first half of the year, 2025, has been really busy. Even up to this past week, I did 3 deals in 3 different price categories. So things are really active so far. How about you? How are you seeing things?
Just to echo what you're saying, we finished the same amount of business we did all of last year, just in the first 5 months of this year. So, I mean, given the way things are going, if 2025 continues in this trajectory, it looks like it could be a very good year.
Let's bring in our first special guest, Yuval Greenblatt, who is our Senior Managing Director of Operations here at Douglas Elliman. Yuval, thank you so much for joining us today.
Hi, Iman. How are you, Gabrielle? Nice to see you again.
So, Yuval, how have you been seeing the market this year?
Yeah, so far the market's been pretty strong, but it's really picked up steam over the last month and a half or so. Just this week alone, I've had two of our colleagues that are in bidding wars and are trying to sort of manage those. But it's not easy always to manage, as I'm sure that you've known in the past when you get into these situations when more than 2 or 3 people want the same property, particularly after one had been on the market for quite some time without any offers.
It's so funny you say that because we had the same thing happen to us this week. We had a property that
I'm in a bidding war now, actually.
In both of these cases are downtown. One was in the Village and one in Midtown South. And the interesting thing was one's been on the market without really a lot of activity until very recently, and there was still even more calls to come see it. It did come down in price from what it had been, but still, it pushed back up over ask, which is an interesting thing. And I think that we've seen that in the numbers that, these bidding wars or over ask has been perking up a little bit. The numbers are reflecting that. So if I put it into perspective, the sales market is definitely warm to hot. The sales market in Brooklyn is even hotter, and the rental market is the hottest. And a lot has to do with seasonality. Generally, the season for rentals is further into the summer. We're in, our peak sell season, and we're definitely seeing the signs of that.
Excellent. Talking about where we're going to, let's say, as far as like the rest of the year. So it's been strong so far. So where do you see it going? Do you see it continuing? How do you see the market trending for the rest of this year going into next year?
Look, I think seasonality always plays a role. So as we head into summer, things generally cool off. There's some talk about the new budget proposal, assuming that it does get approved in some point in time. But there is this new salt cap upgrade in there. And that could have a very positive influence on our market because, I think we obviously know that our market is highly impacted by the SALT tax. Ultimately reduces the ability to write off your real estate taxes from your federal taxes. It's a big benefit to have that increased. Hopefully the numbers come in as high as possible for our market. That will definitely help drive activity in our market. So if that comes through in summer, we could see what's normally quieter time in the marketplace, given a little bit of jolt of new energy. If interest rates would cooperate, that would also be a big positive for us. Those kind of things should be more on the positive side. The mayoral election, I'm a little bit more negative on. We do have a potential candidate in the pipeline. She's not running in this election, but I think if she does become the mayor in the future election, I think that the city could have like its Bloomberg moment once again. But I don't believe she's a candidate this time around. But there have been some rumors floating. Not that I'm that dismayed with Adams. I know a lot of people are critical of him, but I think he got crime to kind of a reasonable level. There's been too much noise around, there's, I guess, always noise around politics. But all these things influence our market. The SALT cap increase, I think, will be very, very positive for our market. Could be like an interesting wild card coming into what's seasonally a slower time of the year for us. Whether people are buying or renting, they're coming here, right? And that's what we want to see.
So you have a positive outlook. You feel that the remainder of the year going into next year, the factors that you described with the increase in the state and local tax, increase for deductions, and what happens with the mayoral races and whatnot could certainly have a positive effect on the real estate market.
If you think about the period that we've gone through now, it's noise about tariffs, no tariffs, the economy, interest rates. You could argue that there hasn't been a ton of visibility. The gyrations in the stock market that have gone on. Our market's hot. There are people that are in the market and buying, so it's almost like that's become noise for them.
Mhm.
not necessarily paying that close attention to some of the uncertainty. Normally, when there's uncertainty in the marketplace, in macro and micro marketplaces, you see a slowdown in people's buying activity and rental activity. It
Right.
wasn't in 2020.
It's not taking the same normal effect as we normally would expect.
Yeah, it seems like our prospective clients, for the most part, addressing that is just some noise that will be resolved in a positive way over time.
Amazing. Thank you. Yuval, it's always so interesting to hear you speak. You're so knowledgeable about the markets and really appreciate your take on the market. Thank you.
Thank you, Yuval.
Just for full transparency, it's not me. This is AI.
Thank you, Yuval. Thank you
Of
so
course,
much.
thank you. Always great to see you all.
That was very interesting about the sales market. So I'm very excited to get into the rental market.
Yeah, let's talk about rentals now. Should we bring in our next guest, Hal Gavsey? He is the Executive Vice President of Sales and Residential Leasing here at Douglas Elliman. Hi, Hal.
Hello, all. Hello, Aman. Hello, Gabriella. How are you guys doing?
Great.
Good.
Thank you so much for joining us.
Of course. Always a pleasure.
So Hal, the burning question on everyone's minds is New York City's rental market ever going to cool down? Is it still heating up? What is going on? I mean, it's crazy.
Yeah. So the rental market is really so strong. It's on fire. So many agents and customers ask, when is it going to slow down? Where we are right now, this is the beginning of the peak season. I do not expect the rental market to slow down once we get through August into September, when historically and seasonality comes back to play, where things do start to slow down in all segments. Listings that are hitting the market are moving very quickly. Such a rapid inventory is still very tight, and that's driving the market. I think also there's probably some demand from maybe some potential buyers still kind of uncertain with regards to rates, just kind of being forced still into the rental market right now. I'm not sure what you guys are seeing, but I know from speaking with all of my agents, it's quite strong.
You mentioned days on market for luxury listings. It seems like it's very low, right?
So luxury listings right now, from some specific new listings that I've seen, we've had luxury rentals that are 15 and or above rent within 1 to 3 days. And again, that segment of the market is also very tight.
So I guess as a renter, there's really no relief in sight. You see it, you should just grab it.
New York City is always a tight market. The vacancy rates hover around 2%. I think we're still seeing a shortage of inventory due to a ton of the legislation that changed even in 2019, where we still have stabilized apartments being warehoused, and that's contributing to the inventory shortage.
I'd like to talk a little bit about the FAIR Act, right? The Fairness in Apartment Rental Expenses. Is that what it stands for?
Correct. So what's going on? So for those who don't know, the FAIR Act, in simplest terms, the way it reads, if it becomes effective, because right now it is not effective, it was passed by the New York City Council members in November, and the earliest it could become effective would be June 11th. But the way it reads is whomever hires the broker would be required to pay the broker fee. That's the simplest terms. However, there are a ton of nuances to it that could cause some issues. However, we had an oral argument with the New York City judge on May 2nd, where she heard both sides. What we're being told by that judge is that she's going to make a decision on or before June 11th to decide either if this legislation does become effective, which would be June 11th, or if she grants what we filed for, which is a temporary restraining order, which would pause the bill and force this to go into the courts to be decided, which would then delay this entire process and likely take, I would say, a minimum of 12 months for any decisions. Because of the FAIR Act and the uncertainty, I believe that's also fueling the rental market. Now, what I'm seeing, we have a lot of landlords that we are already pushed through June and July leases. So we are now into August. I think a lot of these landlords wanted to get in front of the FAIR Act should this become effective.
So if it does become effective, how do you see that impacting the market, the rental market?
Yeah, so if it does become effective, what's ultimately going to happen, a couple of things. One, I've spoken with dozens of landlords, and a lot of these large landlords, they're not going to be affected by that this year. They're just going to bake that broker fee into the rents. So what's going to happen for the consumer, whom they're trying to help, those consumers are going to feel it the most, because these rents are going to be increased anywhere from 6 to 10% to cover the broker fees. I think in addition to increased rents, what's going to also happen is going to be less transparency for the consumer. And that's a real unfortunate unintended consequence of this legislation. If an agent advertises an open rental listing, that constitutes as a landlord-agent relationship, thus forcing the landlord to have to pay that broker fee. So a lot of those open landlords are just not going to be promoting their product out there with agents because they either can't afford to pay that broker fee or don't want to. So there's going to be less transparency, but we'll see what happens.
Okay, so we'll have to see what happens.
Yeah, absolutely. Thank you, Hal. Thank you for giving us such good knowledge right from the trenches. It's really refreshing to hear your take on the market.
Always a pleasure. Always great seeing you both.
Thank you. Thank you so much.
Thank you for having me.
I just feel like something that's been on everyone's minds these days, Gabrielle, is mortgages. Mortgages have been high the last 2.5 years. Very excited to talk to our next guest. So our next guest is a longtime referral partner for us. We've worked with for years. His name is Adam Turkowitz. Adam has worked for a major bank for many years and now works at a company called Cliffco, which is a very wonderful new dynamic mortgage lending bank.
Hey guys.
Hey, Adam.
Gabrielle, so good to see you. I haven't seen you in a long time.
I
How have you
know.
been?
So great to see you.
And Iman looking good as always. How you doing?
Great. Thank you so much, Adam. Long time.
Awesome. Yes, for sure.
Adam, has done a lot of very tricky deals for us that, have been very kind of complicated, that needed somebody who had a lot of experience. He's always delivered. So I really appreciate you, Adam. Thank you for everything you do. So I guess the question on everyone's minds, Adam, these days is, mortgage rates have of course gone up from 3% to, I guess they're about 7% now, let's say, give or take. Is there going to be any relief in sight coming anytime soon? Rates just seem so high. I mean, what's happening with the state of the market right now?
Thanks for the question. It's really, really important to understand where are mortgage rates relative to historical data points. So if you take a look at this, what you're going to see is this is the average 30-year fixed rate. The average 30-year fixed rate trending on that mountainous-like line that's going up and down over the years. And when you look at that line, what you're going to see is, currently the average 30-year fixed rate is right around 6.89%. And that's coming right from the Freddie Mac primary mortgage market survey. So 6.89% is where the 30-year fixed rate is, right now. If you look at that orange line, that's the average 30-year fixed rate from 1971 all the way through present. You'll see that that's showing you that the average 30-year fixed rate is about 7.64%. When you look at that 50 some odd year average, we're still about 50, 60 basis points below the all-time average of the 30-year fixed. A lot of people will say, well, look at the left side of the graph, right? The left side of the graph, that's the 1980s where interest rates were at, 15, 16, 18%. And you're not wrong with that, right? The highest week for mortgage rates in the history was the week of October 9th, 1981, where you see that peak. Interest rates right there were about 18.63%.
Wow.
So, and if you fast forward all the way to the right side of the graph, right around COVID-19 in 2021, it was the week of January 7th, 2021, the average 30-year fixed rate was 2.65%. Peaks and valleys, right, in terms of the mortgage market. But when you talk to a lot of sophisticated buyers, financial advisors, they're going to say, well, Adam, it's not fair to say that the average 30-year fixed rate is 7.6% because you've got this decade of mortgage rates that are in the teens. And I don't necessarily disagree with that person. So if you look at the green line, I've stripped out all of the interest rate volatility that we saw in the 80s, 70s, and leading into the 90s, where interest rates were over 10%. I've also stripped out all the data points after 2008, because if you're going to make the argument that pre-1990 should be taken out, you should also make the argument that post-2008 should be taken out, because that was an environment of immense government intervention and influence in the markets that caused rates to go down. Quantitative easing and the Great Recession, we remember all that. So when you look at that period of time from 1990 through 2008, the average 30-year fixed rate was 7.32%. So again, being rates at about 6.8% right now, you're still about 40 basis points below, what are we at, about an 18-year average. And then the last thing to give the full picture is if you look at interest rates from 1990 all the way through present, so strip out the 80s, where rates were super, super high, but include post-2008, you're still looking at an average 30-year fixed rate in that was a 34-year period of about 6.1%. Although the rate today is higher than that time frame, you also have to take into consideration you had about a decade built into there where the government was just purchasing mortgage-backed securities and treasuries, driving mortgage rates lower. That's gone, right? So we don't have that anymore. That green line as something that is more in line with, I would say, a more stable market. So interest rates are still lower. They're trending up right now a little bit. You'll see that interest rates in January, where we started the year off, was 6.96%. They came down a little bit since March. They've been climbing back up. The May rates right now are about 6.82%. So we're getting right back to where we were at the beginning of this year. We had a couple of months where rates came down. We're getting right back to where we were at the beginning of the year.
Thank you.
So Adam, I'm very curious, what is trending right now in your different mortgage products? What are you seeing people using the most of?
So everybody's trying to figure out how to get a lower payment. We're seeing a lot of clients start to look more at like a 5 or 7 year ARM. So like, let's take, for example, the Douglas Elliman report for Q1 of this year. It had the average price for a co-op at about $1.5 million, a little bit more than that, but just round numbers, let's say about $1.5 million. So if the average co-op buyer was financing 80% and financing 1.2 million, their mortgage payment today, based on a rate of 6.875%, is about $7,900 a month. If you looked at the average 30-year fixed rate, right, we went back to that, I think it was the purple line, which was from 1990 all the way through present, and we saw it was about 6.1%. If you use 6% as a basis, the mortgage payment is about $7,200 a month. Mm-hmm. And that's right around where the 5-year ARM is trading at, right? The 5-year ARM is trading right around 6%. For all the buyers and the real estate agents and even some of the mortgage bankers that are out there that are waiting for interest rates to drop below 6%, it's a pipe dream. It's likely not going to happen. So if you can set your expectations at something closer to the mid 6s or 6%, that's probably more in line with what historically and statistically are supported by the data. So we're seeing a lot of clients go for a 5 or a 7 year ARM with hopes that the average 30-year fixed rate in that time frame will drop from roughly 6.8 to 7% down to something in the mid to low 6s. So we're seeing a lot of people take that 5-year ARM to try and almost mirror what the payment would look like if the 30-year fix was at 6%, hoping that rates come down. The benefit that New York City has over most of the rest of the country, New York City is a much more transient market. We don't see a lot of buyers in New York City buy a home and stay in it for 20, 30 years. The life cycle of a buyer in New York City is that first-time buyer is buying a studio or a 1-bedroom, and then they're trading up to a 1 or a 2. So they're constantly trading in and out of apartments, and so they're constantly taking out new mortgages. So you don't normally see the New York City buyer in a property for 10, 20, 30 years. So the ARM product is more prevalent in the New York City market. So that's one thing that they're doing. Another thing that we're seeing is, when appropriate, we're seeing buyers taking interest-only loans. So that'll help bring down the payment as well. Again, there's some risk involved in that loan. If the client isn't able to refinance at the end of the interest-only period, there's some risks there. But for some of the sophisticated buyers that are out there, that's one product also that is being used pretty dominantly by some of our buyers.
So basically what you're saying is, if you get an adjustable rate mortgage now, you're basically paying what the historical rate would have been if the rates were a little bit more in line with those averages. You're betting that rates are going to come down.
I'm betting that rates are going to come down, but I'm betting that rates are going to come down to a realistic level, right? So, I love data. I'm a data junkie. When you look at the historical snapshot that I provided you earlier that was up on the screen, one thing that stands out, if you look at the rates, the average rates before 2008, only 3 times in history did you see the average 30-year fixed rate sustain less than 6%. For a 12-month period, and it was 2003, 04, 05. Aside from that time frame, the rates never held under 6%. So statistically, kind of 6% is that floor. Not to say it couldn't go lower, but typically what's going to cause rates to go significantly lower, it's going to be some sort of an event out there in geopolitical, war, financial, that causes the markets to move drastically.
What you're saying is basically you get the 5 or 7 1 ARM and your rates at roughly 6, which is roughly what rates we're forecasting would come down to. So instead of paying, let's say 6.8 or 7%, you pay that 6% rate. And then with the projected reductions in rates to float down to what we expect to be around 6, you'll just lock it in at that rate for the foreseeable future afterwards.
Exactly. We'll either do a refinance, or depending upon what the index the ARM is based on, it might just flow back down there organically.
Amazing. That's great. I know we have to flash your disclaimer up, so do you want to show?
Thanks for letting me check the compliance box.
Excellent. Thank you.
Of course.
Adam, thank you as always. It's so good to see you. And
Good to see you.
Look forward to doing many more deals together. Let's keep rocking and rolling. All right. Wow. This has been a very, very stimulating conversation, Gabrielle. The experts are all chiming in kind of along the lines of what we've been seeing as well.
Yeah, I think everything that they're saying is really spot on with what we've experienced with our team. We'll have to stay tuned and see what happens with these different factors that might be affecting the market.
Absolutely. Well, if you have any questions about what you heard about today on our June 2025 market discussion, or you'd like to get in touch with us regarding buying and selling in New York, and of course leasing, feel free to contact us and send us a direct message. Once again, I'm Iman Bacodari.
I'm Gabrielle Correo.
And we want to thank you very much for watching.